Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we need to. As we said last week, I hate to lose money. I also hate when my football team loses. Man, the Broncos look bad. So the Federal Reserve met last week, and in their press conference, there was a very astute question. And the question was, do you think that the base case is still a soft landing? And Powell said, no, that's no longer the case. So if it's not a soft landing, and we know that they're looking for the economy to slow down, it must be a recession, right? The market has not discounted the recession in it at this point. And it has not even discounted the 4.5% interest rate on the 10-year Treasury, which could get worse. So the market's currently expecting the 10-year Treasury yield to drop and therefore to have a rally. So we'll have to watch that. So some quick thoughts on the market. Looking kind of a big picture, maybe a little bit longer term, the S&P 500 is off roughly 9% from the high on the first day of trading in 2022 was a high, roughly 9% from that point to current. And the NASDAQ is off around 17.5% from its high, which was in late 2021. So most investors are now down roughly double digit in their stock portfolios from that high level. We don't have to go through that. So there's just things I want to talk about at the end, talking about wealth management a little bit. But most investors are down, and the bond market's been horrible as well. So everybody has more or less a negative return over the past couple of years. So I feel pretty good about having flat to positive sort of returns, maybe down a little bit. It's paid to be cautious. So point number 4, it's paid to be cautious. And right now it's timely to be cautious. The bond market down a little bit this year, but we think that there's now value in the bond market. The Federal Reserve, as we mentioned, kind of moved to a recessionary scenario. In our opinion, they did that. The market's not picking up on that point yet, I don't think. So we want to have a multiple year buy in front of us, a multiple year move up in the stock market on a fundamental basis before we would get really aggressive. The technicals might lead us there before that, but on a longer term basis to move significant assets into the market, we want to see a multiple year period where we're going to have good performance. And that's when the market discounts the recession. We believe that's when you want to really start to get aggressive on stocks. The stocks are currently about 6% overvalued versus bonds. That's the 4.5% yield on the 10-year Treasury and the $246 in earnings next year for the S&P 500. We don't think they're going to make the $246, but yields might be lower by that time. The policies out of Washington, D.C., and the way this country has been managed over the last couple of years, it really doesn't give investors any confidence. All the illegals crossing the border. Now, I can't believe we're talking about this in our market thoughts, but it's becoming an economic issue. Could New York City go bankrupt? It's possible. Maybe the federal government will have to come and bail them out, but it's possible. So some cities are at the breaking point in terms of what they can handle on illegal immigrants and the cost that will have, and all the medical costs and education and housing for 8 million people for the next 10 or 20 years. It's just completely insane what's happening there, and it's hurting the investor psychology. Right now, we think the most important thing in the markets is the 10-year Treasury. It's crossed 4.5%, feels like it's going to go higher, but as the economy slows down or goes negative, we think it probably goes down close to 4.25. Still, you got to watch this. If the 10-year Treasury breaks much above 4.5, it's going to get ugly in the stock market. The stock market's currently oversold based on what's going on with the Fed meeting and higher interest rates. If the bond market would rally or the yields decline, then you're probably going to see a nice rally in the stock market. keep in mind, we talked about this last week, the Federal Reserve's balance sheet is declining at about a 1% rate per month. Okay, it's down roughly 9% from its high, so about equal to the 9% drop in the S&P 500. So there's a high correlation between the two. If it continues to drop, it continues to stay on pace with what the Federal Reserve expects, that's going to be a big overhang to the markets, and so roughly a 1% hit per month. So earnings have to be really strong to offset that. Inflation has been a big problem. So we're thinking, okay, we in a recession. Here's the problem with the economy. It's inflation primarily. Okay, so you had this massive move in inflation from the low in 2020, a 20% move in the CPI. That's enormous. Consumers can't keep pace with it. There's no way wages have increased 20% over that period of time. So it's killing the consumer, particularly at the low end, but everybody feels it across the board. Things have gone up quite a bit. It's now becoming expensive to live in the United States. Key point, watch the PCE. This is one of the Fed's favorite indicators on inflation on Friday. We think it's going to uptick again because of higher energy prices. Now, mortgage rates are another big issue for the consumer and leading to a recessionary type of scenario. So at the bottom in 2020, mortgage rates were below 3%. Now they're over 7%. It's kind of interesting to think about this. There's probably an opportunity in the mortgage markets to buy 30-year mortgage-backed securities at 7.5% to 8% when they get there and lock that in for 30 years. That would be a great return. But if you look at the four sectors of the economy, so go back to your college economics, if you took economics in college, you got government likely to be down next year versus this year. That's what they're fighting about in the House and Congress right now. Consumer, clearly, we think that's going to be down next year, given all the headwinds, primarily from inflation and higher interest rates, credit card debt, and then the student debt's coming back will have to start to be paid on as well. Housing is part of the investment category of GDP. That'll likely be down next year in terms of the quantity of being invested in housing. And then exports. All of our trading partners are doing poorly. It seems like everybody's in a recession, particularly China. China's really struggling. So the four parts of the economy, all kind of weak, all deteriorating. So having a recession next year wouldn't surprise us in the slightest. We think it probably has started or will start in the fourth quarter. That's when we'll start to see potentially some negative GDP growth. The street's not expecting that. Wall Street's not expecting that. So that's going to be something that the market's going to have to navigate. So likely we'll have a weakening stock market because the economy is weakening. Stock market valuations. Okay, here's the major problem. You've got the expectation of a 12% increase in earnings next year. You peel the onion back, and they're looking for 5.6% revenue growth in 2024. That implies nominal GDP of about the same. So is it possible to have 5.6% revenue growth next year? I don't think so. I think it's a long shot. I don't think that's possible. So this 12% earnings growth is going to have to come down probably in a significant way. Again, the 10-year Treasury impacts the valuation of the stock market. The 10-year Treasury at 4.5% kicks off about a 16.4% PE multiple. So the market's not believing the PE, the 10-year Treasury is going to stay at 4.5. The market still believes the 10-year Treasury is going to trade back down. So if you take the current expectation of earnings growth for next year, which is too high, plus the 4.5% on the 10-year Treasury, you get about negative 5.8% on the S&P 500. So down to about 4070s where it should be based on the current expectations. So thinking about wealth management a little bit, all right? So we have this negative fundamental backdrop. Valuations are high, interest rates are going up. what do you do? Well, you have to protect yourself. So if you're in equities, and you can see here, this is where our algorithm got a buy signal. This is where it's got a sell signal recently. So we paired out as it broke the 50 and 20-day moving averages. We pulled back at about 50% and got defensive with it, and recently got hedged up in most of our strategies as it's broken through the 100-day moving average. Why the 100-day? Because we're too far away from the 20-day. So there's too much risk to wait on the 100-day to get defensive. So when you think about your portfolios, if you're retired, okay, you think about, okay, how long am I going to live? How much money do I have? And then you start to think about, if that's okay, then you start to think about, oh, my risk is the stock market, or maybe even the bond market, but primarily the stock market. My risk is in stocks. So how do I deal with that? It's really hard to do that with traditional strategies. My investment philosophy is don't lose money in a bear market. So I've got strategies that return roughly 5%, to as high as much as 15%, and some that are more over time. But those 5 to 15 sort of strategies are tactical or loss averse strategies. We manage the risk. So we'd like to get about a 7.5% return without the volatility. Now, what would be really disappointing for us if we were down more than 10% in any sort of bear market. That's pretty extraordinary when the market sells off at times 40 or 50% from high to low in bear markets. Not saying that will happen this time, but it's a possibility. The market has to go through these expectation changes in terms of the economy, maybe or likely going into a recession, and higher interest rates. So we think that there could be 20% decline in the overall stock market on top of the roughly 9% decline you've already had from the high. That gets you close to 30% decline in the overall stock market from high to low. So be cautious. We might have a rally here as interest rates maybe come back down a little bit on the 10-year Treasury, but don't count on it. So be nimble. So if we do get a rally, our algorithm will turn positive and we'll make some money during that period. Thank you very much. Please hit like, subscribe, come to my website and get the Market in a Minute hard copy weekly. In the meantime, how about those Buckeyes? They did beat the Irish, but what a crazy game. Came around to the very last play. Take care.